You're watching Deal Flow, the show that looks at deal making. We ask about the numbers, the structures and the passion. And we talk to the deal makers, the advisors and the financiers. I'm Erica van der Merwe, delighted to be here this evening. Grooming your business for sale is a demanding process. It's an emotional move and it also requires all your mental faculties. We look in tonight's show at the checklist of considerations as you prepare for an exit from your business. But we start with some of the deals of the week. Steelmaker ARCELORMITTAL will sell a 21% stake in its Algerian unit at a nominal price to the Algerian state, thereby allowing the country to become a majority shareholder in that asset. Britain launched plans to sell 6% of its stake in bailed-out LLOYDS banking group, marking the lender's first crucial step towards a return to the private sector. UK Financial Investments, which manages the state's bank holdings, said in a statement that it will seek to sell 4.28 billion shares to institutional investors. And a handful of potential bidders are lining up to look at BlackBerry, but initial considerations suggest interest is lukewarm and buyers are eyeing parts of the business rather than the whole company. According to sources, private equity firms, for instance, are mostly interested in businesses such as BlackBerry's operating system and the patents around its keyboard. That's according to sources. Any business owner who sells out naturally wants to get the best price for his or her asset. But ensuring a business is attractive to buyers can take years of preparation. We're taking a look at the major considerations when selling a business. Joining me in studio to discuss this, Carel, Vosloo, co-head of corporate finance at Rand Merchant Bank, and in Cape Town, Andrew Morris, director at Mazars. Welcome to both of you. Good to have you here and to have your expertise on tap. So I'm going to start with you, Carel. So getting one's house in order and getting the business in order for a sale, presumably there are all sorts of considerations in making sure that the business is cleaned up and really attractive. And one thinks of selling a house, so having the bread in the oven and making it smell good. So what are the considerations for a deal maker?
It's certainly very similar, maybe not as quite as interesting as baking bread and making the house smell nice, but there's certainly quite a thorough due diligence process that's typically associated with getting the business ready and prepared and actually making sure that you know all the various parts of your business in the sort of detail that a buyer would ultimately want to look at it. In our experience, one of the most important phases of the selling process is the process pre-launch, the getting prepared and doing the internal due diligence. So certainly, making sure that all the legal arrangements, all the environmental arrangements, and all the you call it rather boring sort of things are in place is very important.
So Andrew, we know that when a buyer looks at a business, they do this kind of due diligence from their side, and they will do that. So you just make sure that you eliminate any potential questions by doing such a similar due diligence yourself and ticking the boxes.
Yes, essentially you would preempt the questions that would come from a due diligence. Typically the main one would be the transition in management. If the shareholders are part of the management team of the business and they're going to exit, that's the biggest key area we'd need to address and make sure that those risks that we highlight can be addressed during a sale process.
So you, as advisors, I would imagine typically arrive on the scene at this point where a sale is considered. But presumably the best approach to a sale and readying the business for a sale is to consider an exit right from almost the inception of that business, to always have that vision in mind that ultimately you're going to sell the business. So thinking of who the typical buyer could be of your business and packaging it appropriately over the years. Andrew?
No, absolutely. But as with anything, one forms a sense of complacency. A lot of the businesses we look at are large companies but run as a family business still. So what happens is it becomes more of a lifestyle than an entrepreneurial venture where you're looking for an exit. And that's where we would come in and assist with the transition to show how a few house cleaning areas could be addressed to maximize value upon exit. It's not typically the first port of call on anyone's agenda unless you're an entrepreneur that moves from venture to venture, typically to make your money out of an exit.
So Carel, specifically, so what I'm hearing is you needing to almost institutionalize this family business, this lifestyle business, putting governance in place. Are there regular board meetings? Are there minutes? Are there audits, etc.? So what are some of the typical failings of an owner of a mid-sized business?
Yeah. It's a good point, and Andrew raises an interesting point that some people are just more focused on this, and they're actually really quite adept at making sure a business is run in a manner that's almost consistent with the way that a listed business would be run. So we see relatively small businesses run in a way that's got sort of best of breed from a governance point of view and from a accounting point of view. So sort of some of the things one would typically look at is, for instance, do they have the sort of independent committees that one would expect for a sophisticated company? Do they have the internal controls and those sort of things in place? One would place some reliance on a credible auditing firm. That's an important thing. But I think just as Andrew also mentioned, the separation between the business and the owners of the business is a critical thing. And as I say, some clients are really quite focused on that from early on, and others not so much.
Is there often emotion in that, Andrew? So you spoke about the lifestyle business. This is someone's baby. So now the thought, they want to exit, they want to liquidate, they want the better life from here onwards. But it's also letting go and knowing that someone else might not be so concerned about your asset.
No, absolutely. Sometimes the role of the advisor is, part financial, part psychological, and typically there's a term called endowment bias when one values their own asset more than a like asset that someone else would hold, and that's how you would see your children. They're always performing to the best and making you proud. So a family business is always going to be filled with emotion and connections and nostalgia and experience. And that's something that we have to come in and just make sure we can manage that and make sure that the transition and the exit is done to a way where if it's a family business which has a name attached to it or a brand, they can be happy that the new owners are going to take it forward in a vision that they saw fit when they started the business.
So Carel, Andrew, referring to these new owners, typically if you're looking at the mid-size, small-size end of the market, who would the typical buyer be? What could those exit strategies look like?
So I suppose one could categorize them into perhaps three broad categories, and I think if we're talking about mid-size and smaller deals, then one of those would perhaps not be relevant. So we would typically say you can go for the public market, so you can IPO the business. That'd be one source. Secondly, one could look at trade buyers.
So just go back. So a listing, what would the minimum market cap there be? About $1 billion?
Yeah. So I suppose it depends on what you want from the listing. If you want the stock to be well covered and followed and have a deep investor interest, including possibly offshore buyers, then you're really talking about companies in between, I would say, upwards of $4 billion is probably sort of where I would draw the line to attract offshore interest. And of course, it also depends on the extent of the free float and not only the size of the company. But certainly there are many companies listed of a much smaller scale than that, and perfectly successful listings as well. Perhaps less liquidity, less coverage by the market, but there's a share price and it trades, and there are people that are interested in those stocks. So I think once it gets arguably smaller than R1 billion, I think the liquidity is usually quite low. So one would need to evaluate very carefully whether in that instance a listing would be the best exit for the buyer from a value point of view.
Yes.
And also bearing in mind that on listing you're very unlikely to sell out to 100%. You're more likely just to exit a stake.
So you've spoken about listing as an exit option. We'll get some of Andrew's ideas as well. So what are the other options?
So if you start with listing, second one I would say is a trade buyer. So someone that's in the industry or someone that might want to extend their business into the industry. So that's obviously a fairly popular sort of source of interest. And then finally a financial sponsor, so typically a private equity fund or such like.
Andrew, you might want to add to that, but if I could ask you sort of a related question, is there a sweet spot for deal size in terms of getting a quick turnaround to that sale?
Typically, the smaller the deal, more of the work, and that comes through from what we spoke of earlier, financial structures and having financial information on hand to expedite a deal. But when it comes to sweet spots, it always varies. You can't say each deal is different and unique in its own way, and I find deals are taking longer and longer to execute and close because of the bid-ask spread between buyer and seller, and because of certain other issues, raising capital, etc. One thing I think Carel didn't mention also was the management buyout option, which is the second tier of management taking over from existing management, which is a nice deal because banks see that as lowering execution risk, knowing that the transition and the management team are in place to take over.
I've probably left one of the most important issues till last, and we've only got about a minute. So, Andrew, let me ask you about that one, valuation.
No,
you spoke about that bid-ask spread and the gaps. In other words, the seller being completely over-optimistic about what this business is worth.
Well, yes. I mean, I don't like taking a mandate where I feel my client's expectations are not going to be met by how I feel a deal will play out. But it's what I spoke to earlier is the endowment bias. You know, a lot of people in the private market don't realize that multiples trade lower, there's less liquidity as opposed to a listed share. The marketability, the fact that you go through a process of 6 to 12 months with due diligence to sell shares as opposed to phoning your broker. So it's all those aspects that lead to a determinant of price. And you know, typically Mazars Corporate Finance was born out of valuations when capital gains tax was introduced in 2001. So you know, we have a pretty good handle on the owner-managed business space and how to value those intricacies. But again, it's psychological as much as it is financial and mechanical in terms of approach.
Yeah, thank you, Andrew. So, Carel, final word from you, and perhaps also on this valuation issue, what you're seeing and what trends you're seeing in the mid to small end of the market.
Yeah. So I think I would concur that deals certainly are more difficult to conclude in the sort of market where you have a listed market that's unusually buoyant for the underlying fundamentals. So if you have the reference prices looking quite frothy, but the reality on the ground is quite tough, then there is that bid-ask spread. So we're seeing similar things. Certainly there's a good difference between what people expect and what they can realise.
Well, Carel, thank you very much. Carel Vosloo is co-head of corporate finance at Rand Merchant Bank, and my other guest in Cape Town, Andrew Morris, director at Mazars. And that's a wrap of this edition of Deal Flow. Do tune in next week to get the latest news and views on mergers and acquisitions in South Africa and beyond. Until then, from me, Erica van der Merwetz, goodbye.